to this one-day seminar on Indies on NBFCs. It's all of you, as all of you are aware, there have been quite a few changes on this NBFC accounting standards or Indies which is applicable to NBFCs. So we thought that it is apt that we have this session at this point of time before we get into the audit season, busy into the audit season. And we have lined up expert speakers through the day to take us through the implications on NBFC and the accounting standards which are relevant to NBFCs. I request our Vice Chairman Manjunath Hemmalur to escort the speakers, CA Renju Mathew and CA Venkata Subramani, sir. Please. A warm welcome to both of you. Thank you for being with us today. A quick introduction about the speakers for the day. Before that, I would like to take you through the overview of the program scheduled today. So the first session will be by Renju Mathew, where she'll be taking us through the overview of NBFCs and the importance of Ind AS for NBFCs. Also the regulatory framework which are relevant from the RBI perspective to the NBFCs. The second session will be, second and third session will be addressed by CA Venkata Subramani. This will be on the key Ind AS standards which are applicable to NBFCs. Towards the end of the day, it will be CA Giridharan who will be taking us through the challenges of NBFCs in application of the Ind AS implementation, and also the disclosure and reporting requirements which are relevant for the NBFCs. This is the structure of the program. Mostly this will be a workshop kind of a thing where you get into the practical insights of making this Ind AS applicable. So the very important session, so please take advantage of this. Also one announcement is that we have been noticing that people come and sign and then leave just to make sure that they get the CPE. So the attendance for the session will be 2 times. You will get the complete CPE only when you're present in the morning as well as in the evening. So please do take due note of this. We'll now proceed with the introduction. First speaker is Renju. Renju is a chartered accountant and a qualified CPA. She works as a director in a large auditing firm as part of financial services audit practice. She has wide experience in audit of banks, housing finance corporations, NBFCs, and private equity funds, specializing in multiple accounting and auditing frameworks. Renju, it's a pleasure to have you here. Thank you for being with us. R. Venkata Subramani, CAR Venkata Subramani, his introduction goes like this. He is a chartered accountant with more than 3 decades of experience. He began his career in Chennai in the year 1983. He is currently the founder of RVS Bell Analytics Private Limited, a company which is engaged in ECL and lease accounting on SaaS basis to several corporate clients. He is engaged in IFRS and Ind AS advisory services for several clients across the globe and specializes in accounting for financial instruments and lease accounting. He was previously working with Calypso Technology, specializing in hedge accounting for as per IFRS 9. He is a diploma holder in IFRS from ACCA. He is also an All India rank holder both in CA as well as in ICWA exams. His technical experience, he is a visiting faculty in the Institute of Chartered Accountants of India on Ind AS and IFRS matters. He conducts specialized courses on financial instruments for participants from regulators, several banks and corporate sectors. Visiting faculty to the Reserve Bank of India, Staff College for Ind AS as well as on the financial instruments. Conducted training sessions for Reserve Bank of India, Reserve Bank of South Africa on expected credit loss for banks. He has authored several books, and few of them are Accounting for Investments, which are into Volume 1 and Volume 2. He has authored one more book on financial instruments as per Ind AS, published by Walter Clouvers. His share-based payment transactions, Ind AS 102, as well as the effects of changes on foreign exchange rates, Ind AS 21. He is also published, which is published by Amazon Kindle edition. He is authored by him. He has also authored one more book on financial instruments as an introduction as per Ind AS 109. So it's a honor and privilege to have CA Venkata Subramani with us. Sir, thank you for being with us. We'll now formally inaugurate the seminar by lighting of the lamp. I request all the speakers and Manjunath to come out to the lamp.
शत्रुबुद्धिविनाशाय दीपज्योतिर्नमोऽस्तुते दीपज्योतिर्नमोऽस्तुते दीपज्योतिर्परब्रह्म दीपज्योतिर्जनार्दनः दीपज्योतिर्परब्रह्म दीपज्योतिर्जनार्दनः दीपो हरतु मे पापम् सन्ध्यादीपनमोऽस्तुते ओ दीपब्रह्मरूपस्त्वम्
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तदब्रह्मा तदेवामृतमुच्यते अस्मिन् लोकः शतः सर्वे तदूनाद्यपि कश्चन एतद्वैता 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 एतद्वैता
Pleasure to be here. Thank you, all of you all, for having made time to this session. I think the context has been set in terms of what we are trying to do here. I thought that just as an introduction to the rest of the agenda in terms of what are we trying to cover from the applicability of IND AS, I'll just try and cover what IND AS for NBFC means. But before we get to that, maybe just a little bit of introduction on the kind of NBFCs, what is the regulatory framework, what does an NBFC really mean, and what is it that we try and do. Okay. Just maybe an overview of NBFC in India. Can somebody from the audience tell me that what does an NBFC mean and how does that possibly differ from a bank? Because a bank is something that all of us know that does lending operations, takes deposits. Anybody who can tell me what an NBFC is and how does it kind of differ from a bank? Sorry, I can't. Do we have any mics around?
NBFC, RBI restricts NBFC to take deposits and give a loans. So a bank doesn't have that kind of a restriction. They can take deposits and lend. That is the major differences between the NBFC and the bank.
Sorry, you meant that they don't take deposits?
Yes.
Okay. So partially correct, but essentially the most simplest difference between an NBFC and a bank would be that an NBFC would actually have a banking license granted, which gives them a lot of opportunities to have multiple businesses, unlike an NBFC, which is restricted, or rather it is restricted to lending in some form or manner. There are NBFCs which can take deposit as well, but the license that you take for an NBFC for a deposit taking versus a non-deposit is different. So essentially, in a lot of ways, it's actually a shadow bank with not having a banking license and having opportunities of lending, investments, peer-to-peer lending. There are a lot of NBFCs which is classified as housing finance companies, core investment companies, so on and so forth. So if I have to just look at an NBFC, if I just take out the banking license, that is essentially how an NBFC is kind of structured. I possibly covered on the types of NBFCs on asset finance companies, loan, investments, microfinance institution. A lot of you all would have heard or read about microfinance institutions as well. If you compare NBFCs to how a bank works, other than obviously the core banking of savings, current accounts, term deposits, an NBFC would generally take deposits from corporates, from retail investors as well, but that would really be restricted to public deposits to a particular sum. If I talk about NBFCs in the country, the market share, it's unbelievable that it's almost 25% of the market share in terms of the lending that you have in the country. If I just maybe kind of ask a very simple question, how many of you all know how many NBFCs do we have in the country? Just maybe take a wild guess. A lakh? Any other guesses? It's close to about 10,000 odd, which is actually registered with RBI. And obviously there is a host of NBFCs which is actually not registered, or they have been struck off by the RBI due to regulatory concerns or supervisory concerns as well. Now, that brings to me the most important part. Any NBFC which operates in the country needs to be registered with the RBI. There is an RBI license which is granted to NBFCs for them to operate activities, which could be investments or lending, peer-to-peer lending, and so on and so forth. The fundamental change which has actually happened in the last 2 years is actually the introduction of something called as a scale-based regulations. Some of you may be aware, for the longest time, NBFCs, though they were governed by RBI, there was no regulatory framework which was absolutely applicable of having a uniformity in the practices, accounting, compliance, to be applicable to all of these NBFCs. So in the last 2 years, what essentially brought up a big change is actually the introduction of scale-based regulations, which is nothing but splitting up the NBFCs into 3 large segments as base layer, there is a middle layer, there is an upper layer of NBFCs, which is based on the asset size as well as the activities that they conduct. And there is, of course, a top layer as well, but that is actually reserved for RBI to classify certain entities which will fall within the top layer. The fundamental change between the base layer, the middle layer, and the top layer of NBFCs is actually dependent upon the regulations that is applicable to them. There are relatively less stringent regulations applicable to base layers as compared to the middle layer and the upper layer and then the top layer as well, which differs for the governance that they're supposed to have, the kind of disclosures they're supposed to make, the capital adequacy or the internal capital adequacy framework that is applicable to them, the kind of board of directors that they're supposed to have. These are some of the changes or the differences which will be applicable to all the categories of NBFCs. I will not delve too much into it because we'll cover more IND-AS related aspects, but the context of having NBFCs being classified into multiple layers is important, mainly from a governance standpoint. Now, from a key challenge that you see generally for NBFCs, and it will also have some impact on the accounting standard which is applicable to them, as is common for any lending institution or any regulated entity. One is obviously the credit risk. Now, you all may be aware in terms of the kind of risk which is generally applicable to an entity which is in the business of lending. In simple words, lending is easy, but getting the money back is actually a tough job, right? So the entire credit risk which is involved with it in terms of the evaluation of customers, giving out money, etc., is obviously like a challenge that you see in the current regulatory environment that we have. Regulatory compliances, RBI regulations keeps changing. There are a lot of compliances which is now applicable, like I mentioned about the scale-based regulations, which is bringing together a host of revised regulations applicable to entities. And lastly is competition. These are three which I thought is genuinely relevant at this point in time. Competition in terms of the number of NBFCs which operates in the market, and also pretty much cutthroat in terms of how lending to customers happen and what are the fair practices that each entity adopts for them to garner either more deposits or to garner more lending, and obviously try and be profitable in a highly competitive environment. Importance of IND AS, which is the topic that we're trying to address today. As you may be aware, IND AS is actually a global standard. It is aligned to the IFRS, or the International Financial Reporting Framework. The objective of introducing NBFCs or IND AS for NBFCs was to have a harmonized accounting framework which is actually aligned to global standards. It's an improved financial reporting. When I say it is improved financial reporting, it essentially is more transparent as compared to Indian GAAP. It follows the premise of a fair value accounting. It essentially means that you will know from a balance sheet what is it that you will actually get if you sell or you buy an asset. A lot of disclosures which is relevant, the scope of disclosures is widened. Of course, RBI has a lot of disclosures which is generally applicable for regulated entities, but IND AS has a host of disclosures which kind of bring together the risk management practices, which could be liquidity risk, credit risk, market risk, so on and so forth, and a lot of disclosures from a fair value standpoint, and maybe we'll cover some of it in the following sessions as well. Lastly, regulatory compliances in terms of capital adequacy ratio, liquidity coverage ratio, all of these are now dependent upon the IND AS financial numbers. Having said that, of course, the RBI has relaxation exemptions given in terms of certain accounting adjustments, because a lot of adjustments under IND AS or accounting adjustments under IND AS are more related to fair value, which may or may not be relevant from a regulatory compliance standpoint. Applicability of IND AS to NBFCs. Now, it has been some time that IND AS has become applicable. As you can see, there was a phase 1 and a phase 2 which was there, which pretty much split up NBFCs into two categories. NBFCs having a net worth of 500 crore or more, and the one which has less than 500 but not exceeding 250 crores. The phase 1 became applicable in the year beginning 2018, 1st April 2018, which essentially meant that 31st March 2019 year ending was the year 1 of IND AS implementation. That is part 1 to it. Secondly, all holding subsidiary joint venture companies other than those companies which are already covered under the mandatory IND AS implication notified by MCA were also subject to IND AS implementation. The phase 2 came in the following year, which was after 31st March 2019, which brought into the IND AS framework all entities which were trying to list or which were already listed and having a net worth of 250 crore or more and less than 500 crores. It essentially means that all NBFCs which is less than 250 crores are not subject to IND AS implementation. We have seen over the course of last 4 or 5 years, right since IND AS got implemented, there has been relaxations which was granted either by SEBI or NBFCs, and we see a gradual move in terms of aligning those to market practices or to global framework as well. RBI keeps releasing notification circulars, etc., providing more clarification in terms of either recognition of non-performing assets or investment valuations, etc., which actually kind of aligns it to a more global framework. Okay. The scope of IND AS, which has now been applicable for quite some time, is actually largely 39 accounting standards, which came in first. The key change which we essentially saw over the course of, the whole change from the erstwhile Indian GAAP to IND AS was 3 primary standards, and I'm calling out only these 3 because it's a financial service institution. It will have financial assets or financial liabilities, financial instruments, and the standard which was most relevant to these was IND AS 109, which is financial instruments, which we will cover later during in our session. IND AS 32, which is again on financial instruments, which is presentation as well as classification of instruments. And third is IND AS 109, which is actually the disclosures related to financial instruments, which sets down a lot of disclosures which I spoke about on fair value, risk management framework, qualitative as well as quantitative disclosures. Now I'll spend some time maybe on the key impact areas which came in due to implementation of IND AS. The very first one is actually credit loss, or what we call as is the expected credit loss. Now when Indian GAAP was applicable, the RBI regulations on accounting for impairment, loss, as well as non-performing assets was largely a rule-based thing, which essentially said that if an asset exceeds 90 days, it is classified as an NPA, and the provision that you had to make was based on the rule which was given on loss assets, doubtful assets, standard assets, substandard assets. When IND AS came into structure, the biggest change which happened was to recognize assets at the time when a loss would happen when you've originated a loan. Now, it essentially means that even if you're lending today, if I've gotten a customer and I'm going to lend to that customer, I've already incurred a loss, which means that there is a likelihood that account can actually slip into an NPA, or there is a likely risk that the money might never come back to the institution. IND AS, by virtue of this concept, introduced accounting for loss right at the day of inception, which in general terms is called as a stage 1 asset, where you account for a 12-month expected credit loss. If you see, as you move forward from a 12-month expected credit loss and you look at a significant increase in credit risk, for instance, that is when you essentially say that the asset can actually move into a second bucket, which is stage 2. And then if it exceeds greater than 90 days is when you say it is stage 3. These are just rebuttable presumptions which is given in IND AS, but the RBI guidelines have now actually aligned it to categorizing assets into stage 1, 2, and 3, and then accounting for the provision. What it essentially meant was that you account for loss the day of origination, which takes into consideration a model-based approach of accounting for expected credit loss, and I'm sure Venkat sir would probably cover that. But it actually is a model which you build in to account for future credit losses, which is based on a probability of default, a loss given default, and then the exposure at default, which is nothing but the principal outstanding, including any undrawn commitments as well. One key change to this is also accounting for a forward-looking factor as well, which essentially means that you may have a historical experience of how loss could be incurred in your book, but you also need to factor in a forward-looking element, which is any sort of macroeconomic variables which could have an impact on your default history. So that's pretty much the large change which came in through credit losses. Like I said, it's a model-based approach, which is more akin to a fair value concept, if I can call it. And when IND AS got implemented in those years, 18, 19, 20, entities ended up having a lot more provision on their books as compared to what you would have erstwhile computed under the Indian GAAP framework. Having said that, as per RBI, you also need to kind of compare it back to the regulatory guidelines of how much provision you would have had to incur if you were following Indian GAAP, and there is a comparison that you need to do at the year end and also provide for a disclosure in the books of accounts. The second big change which came in because of IND AS was the expected effective interest rate, which is, as you may have noticed, under Indian GAAP, we essentially account for everything upfront. So if you receive a processing fees or if you receive an income, you account for it upfront. Under IND AS, it will ask you to kind of amortize it over a period of time, which essentially means that, let's say I'm giving a loan today to you and I receive fees in return of that. The fee that I receive and the interest and I earn and the cost that I may have incurred to actually acquire that product, all put together is the income that I would have. Under IND AS, you're expected to kind of account for it over the course of the asset, which is essentially what is called as an effective interest method. in terms of putting together all your incomes and expenses and genuinely seeing what is the effective interest that you would have earned or the effective interest that you would have paid as well. And instead of accounting it for upfront, you also account it over a period of time. It is to kind of account for your incomes or the expenses to the life of the asset. The third big change which came in through is derecognition of financial assets. Under the erstwhile Indian GAAP or the RBI framework, if at all you sold off an asset, you would have, recorded the sale and the asset would have gone off from your books if it met something called as a true sale criteria. It essentially means that you've received money, you've given the asset away, you account for it as profit or loss on scale of financial asset. When you come into IND AS, you're supposed to look at more of the substance. It requires you to see that have you transferred all the risk and rewards of that underlying asset or no. If the answer is no, you can't recognize the asset of your books, so you'll have to bring back the asset into the books. For example, you sold off a loan and you got, let's say, security receipts against it. And of a 100 rupee loan, if you have had about 85% or 90% of the security receipts sitting within you, it essentially meant that you didn't really transfer the risk and rewards. The risk and the reward associated with that particular security receipt is still with your books, which essentially meant that you couldn't re-recognize the asset and to bring the loan back into your books of accounts. The derecognition of financial asset is therefore a very important concept, and that actually attracted a lot of attention from a lot of NBFCs, which wanted to do a lot of structuring in terms of pushing off bad loans, bad accounts, etc., and then try and de-recognize them for the books because it shows a better leverage for them. There are a lot of practical case studies, etc., which is also applicable to the recognition of financial assets in terms of how you could structure a particular derecognition and can you really push that off from your books or no. The one important change which is also associated with the recognition of financial asset is also how do you account for the excess interest spread or the spread that you retain when you sell off a loan. And under IND AS, you need to also gain for this gain as upfront, which means that you account for the excess interest spread over a period of years upfront and push it to the P&L. This also led to a lot of interpretation challenges, a lot of methods in which entities would have actually accounted for those. The fourth is classification of financial assets. This is one very important concept again under IND AS for all entities in terms of how do you really recognize or classify your financial assets. It has to follow something called as a business model assessment, which essentially means that you see whether you're holding an asset solely for payments of principal and interest. If yes, then you account it for at amortized cost. If not, you try and see that are you trying to sell off something out of it, are you trying to dilute something out of it, then you go ahead within a classification called as fair value through OCI. And if your intent is purely to kind of sell and gain out of it, it's something called as a fair value through P&L. These are three categories which is again provided under IND AS for you to kind of classify your assets. This also was a big change when you compare it back to how things would have been accounted under Indian GAAP. Hedge accounting again was a very important change in terms of qualitative aspects which is involved on hedges. It gave you more qualitative framework as well as more structures that you could actually look at from a hedge accounting standpoint. That was a change as compared to the erstwhile Indian GAAP as well. Disclosures, big change, lot of additional disclosures as compared to the earlier Indian GAAP accounting framework came into picture, which involved risk management disclosures, fair value accounting disclosures, classification of financial assets. Within classification, how do you determine fair value? What are the inputs that goes into fair value? Within fair value also, there's a concept of leveling instruments into L1, L2, and L3. How did you determine the valuations for these instruments based on how the valuations would have happened? Those were some of the fundamental changes or disclosures which came in when IND AS got introduced. Employee benefits and share-based payments. As you may be aware, under Indian GAAP, you had an intrinsic value of share-based payments, but under IND AS or the IFRS equivalent, there is a concept of fair value, which essentially means that you account for share-based payments under fair valuation. That was again another big change which came into picture. income taxes, moving on from a balance sheet or rather an income approach to a balance sheet approach in terms of how do you account for deferred taxes as well. That was a big change. And lastly, operating segments. Segment disclosures which under Indian GAAP would have been based on either geographical segments or operating segments. Ind AS wanted you to look at how management or the chief operating decision maker would have looked at segment and how do you account for those. That was largely the changes that came in through because of Ind AS framework. Though these changes were effective right from day one, as things progressed, RBI came out with multiple regulations in terms of within the accounting standards itself, how do you account for certain aspects, what are the policy framework that you should take into consideration, the board-related policies, board-related framework that an entity needs to have for them to kind of account for each of these. It put a lot of onus on the board, the management to kind of have structured policies in place, documentation in place to ensure that you're compliant with the relevant standards. This was broadly what I wanted to cover from an Ind AS framework for NBFCs, and I'm sure there are more topics which we'll cover, which practically would put into structure, the Ind AS 107, 109, etc. I'm happy to take any questions at this point in time, more from Ind AS applicability or NBFCs or any other key challenges that you would have seen or anything that you would want me to specifically cover. Sorry, maybe if you can just pass the mic.
I have a particular doubt about the ARC transaction based on the derecognition of financial assets. So a lot of NBFCs are doing ARC transaction recently and pushing all the loan off book and bringing in security receipts actually. So whether Ind AS permits that or whether we have to derecognize the security receipts and bring back the loan assets. How do you put it in the presentation part of our balance sheet?
So you can only derecognize an asset only if the risk and rewards have essentially passed on when you actually sold off those assets. So to your example that you took in terms of selling off a loan and then having a security receipt in place, you really have to see the structure that you've followed. Let's say you're selling off a 1,000 rupee loan, which is bad. Against that, let's say you've received 50% cash, 50% security receipt, then you have to see substantially, does that mean your risk and rewards have transferred? Let's say you've only received 10% cash and 90% is actually security receipts, which means that you still substantially hold a lot of risk and rewards associated with that, because your security receipts, the return that you will get on that or the cash flows that you will get on the security receipt will actually be dependent upon the underlying cash flows. So if that doesn't come through, then it essentially meant that you still carry the risk and rewards, which then debars you from derecognizing the financial asset. It will need to continue as a loan itself. You then put in a disclosure to the effect to say that, you know, derecognition happened, but virtue of substantial risk and rewards not being transferred, you continue to recognize that asset on the books of accounts. So to your question, a lot of ARCs, or a lot of sale of assets to ARCs, etc., went through this structure, and then there was a clear evaluation that you were supposed to do and see that have the risk and rewards transferred, is there anything associated which ensure that you've been able to transfer the risk and rewards, and then try and see if you are able to derecognize the asset or no.
One more question regarding the significance actually. So for example, let's just say I have 85% security receipts and 15% cash. Then what is the percentage?
There is no specific, clear guideline which is given. 85-15 is generally what the market accepts. But having said that, you will really need to look through the agreement and see that if there is anything else like a credit substitute or a guarantee which is involved in that structure. Generally, we have seen, at least in my experience, we've seen that an 85-15 works to be derecognized, but please do look at the underlying agreement in terms of how the derecognition has happened.
Thank you.
So if you wanted to add anything to that.
even if the 85-15 criteria is met, we de-recognize the asset. In Indies, there is a specific line that your cash flows before the transaction and after the transaction does not change materially. But this falls into that place, right? Even if it is 85-15, 85% security assets and 15% cash. My cash flows after the ARC transaction and before the ARC transaction more or less is the same. Even if I take into then why are the NBFCs kind of de-recognizing this based on the 85-15 criteria kind of thing, as per the market standards, basically?
So one is book management. You know you have a bad loan. When you sell that off, it gets re-recognized. So your base for, let's say for you to compute your impaired asset ratio or your non-performing asset ratio looks better when you actually de-recognize a bad loan. That is one very practical thing that we would have seen. Even if you say that it's a modified cash flow or the cash flow stays the same, what you need to look at is actually what is the de-recognition criteria that you have had. So if by virtue of an 85-15, and I'm just caveating that an 85-15 is not a standard thing that you can follow, but if you do really get to that, and when you sell off your asset, you can actually pretty much de-recognize it as far as the risk and rewards have been transferred. And of course, your book looks better when you have actually hived off a bad loan, right? So your numerator looks better, your denominator looks the same possibly or better, and then you have a better NPA ratio. So that is one way of looking at it. Secondly, a lot of NBFCs do sell off their assets as well because at times it is easier to collect cash flows through an asset, you know, in an ARC rather than you having to put in the efforts to kind of take cash flows as well. You may also see a lot of groups getting into such structures wherein there are ARCs, NBFCs within the same group, and they might actually sell it off from the NBFC to the ARC company as well. That is another way of you looking at why they find it easier to kind of manage the pool of assets as well.
Understood, ma'am.
If there are no further questions, then maybe we can go on to the next session. I'll take up any more questions that you may have as we go through the course of this, and I'm happy to share some practical examples as well, or practical challenges that we see from a implementation standpoint. Thank you.